Welcome to Breaking News to Trading Moves. Our mission today is to look at a very specific set of corporate announcements from Broadcom and, just identify the clear winners and losers across the market based on this new information.
Yeah, strictly looking at the facts today.
Right. So I want to start by presenting the primary headline directly to you, the listener, and stick entirely to the data. Broadcom just raised its 2027 AI chip revenue visibility to in excess of $100 billion.
That is a massive number.
It is. And they also guided Q2 revenue to about $22.0 billion.
Which we should note is above consensus.
Right, above consensus. Plus, they announced a new share repurchase program of up to $10 billion through the end of the year.
Well, those top-line numbers provide a very clear baseline for us to examine. Let's break down the exact Q1 data for you.
Go ahead.
So Broadcom's overall revenue rose 29% to $19.31 billion. But within that broader number, the AI revenue specifically more than doubled. It grew 106% to reach $8.4 billion.
Right.
Yeah, that pace of growth inside a company of this size, it's a critical data point for how capital is migrating right now within the tech sector.
Okay, let's look at this.
Yeah,
Because the mechanism driving these numbers is what really matters.
absolutely.
Broadcom is leaning heavily into custom silicon, what the industry calls ASICs, or application-specific integrated circuits. And they're doing that along with networking.
Right, they are working directly with the major AI buyers to turn specific designs into manufacturable chips.
Exactly. And for you listening, understanding the definition of custom silicon versus off-the-shelf chips is the absolute foundation of this entire trade setup. Let me explain it this way.
Okay.
An off-the-shelf chip is like a multi-tool. It's designed to do a wide variety of processing tasks reasonably well for a wide variety of customers.
Right, because if you're building a general-purpose computer, you want that flexibility. You need it to do a bit of everything.
That's a great way to put it.
But custom silicon and ASIC is completely different. It is a bespoke tool built for one exact purpose. Picture an automated robotic arm on an assembly line that only knows how to do one highly specific weld.
Just one weld.
Right, but it does it millions of times an hour with zero wasted movement. When major technology companies realize they are running the exact same AI mathematical operations millions of times every single second, a multi-tool becomes incredibly inefficient.
Because it's burning too much power.
Exactly. It burns power, it generates too much heat doing things it doesn't need to do. They want a custom chip designed to execute that one specific workload perfectly.
So if custom chips are so incredibly efficient, why did everyone buy general-purpose GPUs in the first place? Like, why didn't we just start with ASICs?
Well, because designing an ASIC takes years, and it costs an immense amount of money up front.
No.
In the early stages of the AI build-out, companies were still figuring out exactly what workloads they needed to run. You don't build a bespoke robotic arm if you don't know what car you're manufacturing yet.
That makes sense.
But what Broadcom is effectively communicating to the market right now is that the AI build-out has reached a maturity level where customers require these bespoke chips at a massive scale.
And at that massive scale, it justifies the cost.
Precisely. When a customer operates at the immense scale of a modern data center, the power efficiency and the specialized processing speed gained from an ASIC easily justify those steep upfront design costs.
Okay, that makes perfect sense. So what does this all mean for the longer timeline? The data supports a multi-year cycle, and it points to a major rotation of capital into three specific areas.
Right.
First, custom accelerators, the ASICs we just discussed. Second, high-speed networking, which solves the critical bottlenecks within these AI clusters. And third, capex durability at the hyperscalers.
Let's start mapping out the winners and losers based on this rotation. We have three subcategories of winners to outline for you.
Let's hear them.
Let's begin with the first category of winners: custom AI, silicon, and networking beneficiaries. If hyperscalers continue migrating their spend toward custom accelerators and the advanced networking required to connect these massive AI clusters, the supplier is tied directly to that build-out stand to gain stronger bookings and much clearer multi-year visibility.
And the specific tickers you need to watch here are Broadcom, AVGO, and Arista Networks, ANET.
Yep, AVGO and ANET.
And where it gets compelling is how those two pieces rely on each other. You cannot just buy the custom silicon. You have to link them together.
Right.
Imagine putting 10,000 supercomputers in a single room. If they cannot talk to each other instantaneously, they cannot train an AI model. The sheer volume of data moving between them creates a massive traffic jam.
It's a complete bottleneck.
Exactly. High-speed networking from companies like Arista Networks, ANET, is required to prevent those clusters from bottlenecking.
We are not talking about standard Ethernet cables here.
No, definitely not.
We're talking about highly advanced optical transceivers and specialized switches that route data at the speed of light. If a hyperscaler spends billions on custom silicon, they are not going to let a cheap network cable slow the whole system down.
They can't afford to.
Right. And that brings us to the second category of winners, the AI cloud capex leaders. These are the major buyers and enablers in the space. Broadcom's extremely strong outlook reinforces the fact that heavy infrastructure spending by big tech remains robust.
Before we go further, let's quickly clarify that term for you, the listener. When we say hyperscalers, we're talking about the absolute titans of cloud computing.
The giants.
These are the companies that operate data centers so massive they consume as much electricity as small cities. The tickers to track in this category are Microsoft, MSFT, and Amazon, AMZN.
And that scale is precisely the point. Even as these companies design and build custom chips, they still require massive data centers, advanced networking infrastructure, and platform scale to actually monetize their AI investments.
Right, because a custom chip is just a piece of hardware.
Exactly. It needs a physical building, extreme cooling systems, power delivery, and a software ecosystem so that end users can actually rent that computing power.
I want to push back on this slightly, though.
Okay.
If Amazon and Microsoft are building their own data centers and designing their own custom chips, aren't they going to eventually compete directly with Broadcom? Why are they considered winners alongside the chip designers?
It is a great question, but you have to look at how the supply chain functions. Microsoft and Amazon possess the capital and the end-user platforms, but they often partner with companies like Broadcom to execute the complex physical design of the actual silicon.
Oh, I see.
Yeah. Broadcom provides the specialized intellectual property that helps these cloud giants turn a concept into a physical chip.
So it's partnership.
Basically. So as Microsoft, MSFT, and Amazon, AMZN, demonstrate absolute capex durability, meaning they are committed to spending billions on infrastructure year after year, it lifts both the cloud providers and their design partners.
That makes total sense. They win because providing that platform scale is the only way they can turn raw processing power into lucrative enterprise subscriptions.
Exactly.
That dynamic is really compelling. It highlights that AI does not exist in a vacuum. To understand how all these physical pieces fit together, we have to look at the third category of winners, which is the semiconductor equipment and manufacturing ecosystem.
The physical builders.
Yes. A massive increase in custom chips at scale translates directly to ongoing wafer demand, packaging capabilities, testing protocols, and tooling requirements. The key tickers here are Applied Materials, AMAT, and Lam Research, LRCX.
If we think about the physical reality of what we are discussing, the equipment makers are insulated from a lot of the risk.
How so?
Well, even if one specific chip type loses market dominance, the overall compute build keeps the manufacturing machine busy.
Right. I love looking at the equipment ecosystem because it's the ultimate picks and shovels play. Think about the physical process.
It's intense.
Whether a hyperscaler buys an off-the-shelf general-purpose chip or they partner with Broadcom to design a custom ASIC, that physical piece of silicon still has to be manufactured.
It has to come from somewhere.
It starts as a raw disk of silicon. It has to be etched with microscopic precision, layered with materials at the atomic level, perfectly packaged to handle extreme heat, and rigorously tested.
And the companies making the machines that do that etching and testing are essentially toll collectors on the entire industry.
Toll collectors, that's perfect.
That is why Applied Materials, AMA, and Lam Research, LRCX, are in such a strong position. The overall compute build practically guarantees that their tooling and testing platforms remain in incredibly high demand.
Regardless of who wins the chip design war.
Right. If the market rotates from off-the-shelf chips to custom ASICs, Lam Research and Applied Materials do not care. They still sell the multi-million-dollar machines required to build them.
Okay, now having established those three categories of winners, we need to balance the equation and outline the losers. Just as capital migrating toward custom silicon creates beneficiaries, it also creates distinct areas of risk. The first category of losers we need to address comprises the general-purpose GPU suppliers.
We need to be very precise here and stick strictly to the facts.
Agreed. No exaggerating.
We are talking about incremental competitive pressure at the margin. Broadcom's momentum in the custom silicon space signals that some AI workloads may migrate to bespoke accelerators over time. The tickers you must be aware of here are NVIDIA, NVDA, and AMD.
Let's break down what pressure at the margin actually means for you listening. Off-the-shelf GPUs remain highly capable.
Very capable.
They will likely maintain a dominant role across many applications, especially training new AI models where flexibility is still needed. We are not saying these companies are suddenly going to stop selling chips.
Far from it. However, when you are evaluating incredibly highly valued companies, any cap on their incremental share is a material risk.
Give us an example.
Let's put some hypothetical numbers to that. Imagine a hyperscaler has $1 billion hardware budget. Historically, almost all of that might have gone to general-purpose GPUs.
Right.
But if that hyperscaler decides that 10% of their workload, perhaps the day-to-day running of a specific AI query, is better served by a power-efficient ASIC, that is 10% of the budget that does not go to a general-purpose GPU.
Ah, I see.
That is the exact margin pressure NVIDIA, NVDA, and AMD are facing. It lowers the ceiling on their growth trajectory in specific massive deployments.
Moving on to the second category of losers, we're looking at legacy networking incumbents. As we noted earlier, advanced networking is vital. The share risk here occurs if AI budgets consolidate around best-in-class platforms.
Right.
When buyers are concentrating their spending on extreme speed, precise telemetry, and total AI cluster performance, it raises the competitive intensity for slower-moving incumbents.
And the specific tickers facing this risk are Cisco, CSCO, and Hewlett-Packard Enterprise, HPE.
Exactly. To really grasp this, though, we need to clarify what telemetry means in this context.
Telemetry is the automatic measurement and transmission of data. In an AI network, buyers require instantaneous telemetry to monitor data flows and prevent bottlenecks across thousands of accelerators. They need to know the exact microsecond a data packet is delayed.
Right, because if one chip is waiting for data from another chip, it just sits idle.
And idle chips burning massive amounts of electricity are a CIO's worst nightmare.
Truly.
The demands of an AI network are entirely different from traditional corporate networking. A traditional corporate network is designed to connect employee laptops, printers, standard company servers. A slight delay in an email being sent is fine.
Barely noticeable.
But in an AI cluster, if a networking platform cannot guarantee absolute peak performance and instantaneous telemetry, it simply will not win the contract. That uncompromising demand for speed concentrates capital into a few select hands.
So why can't legacy providers just upgrade their existing systems? Like why are Cisco, CSCO, and Hewlett-Packard Enterprise, HPE, at such a severe disadvantage in securing this specific AI fabric spend?
It basically comes down to architectural differences.
Yeah.
Modern AI clusters use a spine-and-leaf networking architecture designed for massive parallel data flow.
Okay.
Whereas older systems were often built for entirely different traffic patterns. Re-engineering an entire product line to meet the uncompromising latency requirements of AI takes time.
And the market moves fast.
Right. During that time, the capital migrates to the pure-play providers who already specialize in that highly specific, ultra-fast environment.
Let's outline the third category of risk for you, which is the enterprise software crowd-out risk. This is a truly compelling dynamic of corporate budgeting.
It really is.
When AI infrastructure absolutely dominates a company's technology spending, other areas inevitably suffer. Enterprises will postpone their non-critical software refreshes to free up capital. This crowd-out effect pressures near-term growth for slower, usage-insensitive products.
The tickers you need to read loud and clear on your monitors are IBM, and Oracle, ORCL.
To visualize this, picture a stressed-out chief information officer sitting in a budget meeting. Corporate IT budgets are finite.
They don't have infinite cash.
Right. If that CIO has a mandate from the board of directors to build out AI capabilities, the capital to do that has to come from somewhere. They cannot just magically create more money.
That's right.
Let me guess. It comes from delaying upgrades to perfectly functional but older software systems.
That is usually the first place they look, and this brings us to the concept of usage-insensitive pricing.
Let's define that.
When we say usage-insensitive, we are talking about legacy software, where a company pays a flat annual fee or static licensing cost, regardless of how much they actually use the software.
I see. So if you were paying $1 million a year for a database or an enterprise resource planning software, and it's working just fine, you tell your vendor you are not upgrading to the premium tier this year.
Exactly.
You just renew the base contract and take the savings to buy AI infrastructure.
That is the exact reality on the ground right now. Products that do not directly drive the AI transition, especially those with usage-insensitive pricing models, are the first to be deferred. The software works, so the company accepts a delay in getting the newest features.
Makes sense.
That is why IBM, and Oracle, ORCL, face this specific near-term headwind. The capital is simply migrating away from routine software upgrades and flowing directly into the AI infrastructure build-out.
So we have the baseline data, the specific mechanics of the rotation, the winners and the losers. How do you actually use this information? Let's present a framework of 3 key questions you should be asking yourself to build a strategy around this news.
Question 1 for your watch list. Is the market action you are seeing part of a broad AI infrastructure day, or is it a specific rotation inside semiconductors, from GPUs to custom silicon?
Good question.
You need to observe whether all semiconductor names are rising equally, or if capital is clearly migrating from one subsector to another based on Broadcom's guidance.
That leads perfectly into question 2. Do the networking names outperform the semis on follow-through? For this, you need to closely watch Arista Networks, ANET, versus the broader semiconductor index leaders.
Right.
If the market is truly validating the idea that networking is the next major hurdle for AI clusters, you should see ANET demonstrating relative strength as investors realize that custom chips are useless without ultra-fast optical connections.
And question 3. Are there second-order winners in the equipment space? You should carefully monitor Applied Materials, AMAT, and Lam Research, LRCX.
The toll collectors.
Exactly. You are looking to see if the broader market buys into the more chips, more fabs narrative again. If those tickers show strength, it proves the market believes the manufacturing ecosystem is completely insulated from the specific chip design battles occurring downstream.
Okay, let's bring all of this together and summarize the facts we have examined today.
To summarize the data we have analyzed, Broadcom just strengthened the narrative that custom AI chips are becoming a massive multi-year market. They backed that narrative with a very bullish revenue guide and a newly announced $10 billion buyback program.
Very solid data.
The clear winners in this environment are custom silicon designers and AI networking providers, supported by the capex durability of the hyperscalers and the foundational semiconductor equipment makers.
Yeah, the losers.
On the other side of the equation, the risk is a slow drip of competitive pressure on general-purpose accelerators, as well as legacy networking incumbents who are missing out on the highly specialized AI fabric spend. And finally, we have the crowd-out effect pressuring legacy software budgets.
Here is a final thought for you to explore on your own as you process all of this. If custom AI chips are truly locking in a massive multi-year market, how long until the slow drip of competitive pressure forces the general-purpose GPU giants to entirely rethink their enterprise strategies?
That is the question to watch.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.